Hey guys, it's Richard. You're watching The Plain Bagel. We've had a pretty important update regarding investors outside the United States who hold US stocks or other income-producing investments. As you may have heard, a couple of weeks ago, we saw the big, beautiful bill, the Republican budget, pass through the House of Representatives in the United States, bringing about a number of headline-grabbing changes. But buried within this 1,000-plus page document is a pretty important tax proposal that's likely to hit many investors who are, again, based outside the United States. The so-called revenge tax that's looking to target countries like Canada, Japan, Australia, the UK, and most countries within the European Union, among others. Section 899, titled Enforcement of Remedies Against Unfair Foreign Taxes. A new levy that, if approved and utilized, could end up costing Canadian and other foreign investors up to 20% or potentially even more of the income they generate from their US investments. So today we're going to forgo some frills and hop right into the details of this bill, what it means for the US and these foreign countries, and importantly, how individual investors, whether based in Canada or another country outside the United States, should be treating this information. Because importantly, this hasn't yet been passed into law. The update still needs to go through the Senate, and we might still see changes. And we also don't know if this is just a negotiating tactic, a big stick that the US might wave at other countries during trade negotiations, or whether it ends up being implemented. But if this does go through, it would represent a significant change in US tax policy regarding foreign investors that might warrant some action from individuals. For myself, for the company I work for, this is something that, if passed, will be impacting how we manage client funds. So definitely something that needs to be kept track of. So what exactly does Section 899 do? Well, it essentially looks to charge a punitive withholding tax on investment income earned by applicable persons who reside in a so-called discriminatory foreign country, meaning a country the US deems to be charging unfair taxes against the US, with the levy starting at 5% and increasing another 5 percentage points each year up to a maximum of 20%. As for when this rate would kick in, the section specifies that it will come into effect on the January 1st following the latest of the following 3 dates: 90 days after the date of enactment of this section, 180 days after the date of enactment of the unfair foreign tax, or the first date that an unfair foreign tax policy begins to apply. Meaning that if this section passes through the Senate as is, the earliest we would see this additional fee kick into effect would be January 1st of 2026. And while 20% tax is already pretty hefty to begin with, it would actually be in addition to the current withholding taxes already charged on income earned by investors outside the United States. You see, when an investor that's based outside the United States receives, for example, a dividend from US stocks that they own in their portfolio, generally that's reported in their country of residence as income for taxing purposes. However, before that dividend is actually received by the foreign investor, the US government actually retains or withholds a portion of the income, with that rate typically sitting at 30%, meaning that if your investments were to generate $1,000 in dividends, you would actually only receive $700 of that amount, after which you would then be reporting it to your home country as income. Now, some countries like Canada, for example, have a tax treaty with the United States that actually reduce this withholding amount to 15%, and many governments, including here in Canada, also offer a tax credit to reduce the taxes you pay domestically by the amount you pay with this US withholding tax, so that the ultimate tax you pay on this dividend income is similar to what you would be paying if there wasn't any withholding tax to begin with, which is why some Canadians or other investors might not even notice that there was ever a withholding tax on some of their investments. In fact, many pensions and even the Registered Retirement Savings Plan, or RRSP, a tax-deferred account in Canada similar to the US 401k, are generally exempt from any withholding tax on US income. However, this new proposed section for the US tax law, 899, would look to add a new withholding tax that would not only be on top of current taxes, but may even be applied where withholding taxes aren't currently being charged, meaning that foreign investors could start facing a withholding tax of up to 50% of any income generated from their US investments, and even Canadians who would otherwise see a 35% rate, if this is considered additive to the current treaty rates, could see the rate move higher, given that this legislation is written in a way that allows it to override past tax treaties. As for what income would see this additional withholding tax here, it's not perfectly clear at this point. A separate House Budget Committee report did highlight that portfolio interest interest, which generally includes interest from bonds like treasury bonds, would be exempt, with EY suggesting that this would likely also provide an exemption for bank deposit interest, interest-related dividends under IRC Section 871K, certain short-term capital gain dividends, and certain income earned by qualified foreign pension funds under Section 897L, which has to do with the disposition of real property. It also appears that it won't impact capital gains from stocks. So any circumstance where an investor sells a stock for more than they bought it for, it doesn't seem that this withholding tax will play a part there. So with US stocks specifically at the individual level, it only appears that dividend-paying stocks will see this higher withholding tax. However, this penalty does go beyond this amount to also impact rents, royalties, certain interest payments, and even real estate capital gains, which currently do face a withholding tax for foreign investors under FIRPTA or FIRPTA legislation, with it again seemingly being able to circumvent certain treaty arrangements that currently reduce or eliminate withholding tax, making it unclear whether withholding tax exempt accounts like the Canadian RRSP would ultimately be affected. And even with the added detail of the House Budget Committee report, the vague wording of the bill leaves many questioning whether we could in fact see this penalty apply to things like treasury bonds. And it's not just individual investors who will be impacted by these new rules. The section explicitly defines applicable persons to include not just individuals, but also governments, corporations, foundations, trusts, and partnerships that are considered foreign owned or controlled, meaning that this withholding tax will also apply to ETFs, mutual funds, hedge funds, sovereign wealth funds, REITs, and a number of other investment vehicles and organizations, meaning that if you're, say, a Canadian investor who buys a Canada-listed ETF that holds US dividend-paying stocks, there will still in there be an impact from this withholding tax that ultimately impacts the return you experience. So you can see that there's some pretty far-stretching implications from this. But why are we assuming that Canada and many of these other nations will in fact be targeted by this unfair tax policy? Do all these countries truly enact unfair taxes against the United States? Well, according to the bill anyway, yeah. For one, the bill has a very broad definition of what constitutes unfair taxes, with it including extraterritorial, discriminatory, or any other tax that will be economically borne, directly or indirectly, disproportionately by United States persons, which could be interpreted to go beyond explicit taxes and even apply to things like non-tariff trade barriers, which naturally with the current tariff trade war that's going on is something that Donald Trump has really been harping on. However, the bill also explicitly lists a number of unfair tax policies, including digital services tax and the undertaxed profits rule, or UTPR. And unfortunately, that implicates a good number of countries, with the White House in February explicitly highlighting France, Austria, Italy, Spain, Turkey, the UK, and Canada as countries with digital services taxes, and the administration calling out UTPR plans of the OECD back in January. As for what these taxes actually are, they're both relatively new concepts, with the digital services tax charging a percentage of gross revenue earned by digital service companies like Google or Amazon within the country that the services are provided, rather than the country of residence, and the undertaxed profits rule applying a top-up tax in circumstances where businesses globally pay under 15% in total taxes, with the latter idea actually being a coordinated effort by OECD nations as part of their Pillar 2 plan to prevent large companies from setting up shop in tax haven countries only to carry out business elsewhere to avoid taxes. With 135 jurisdictions currently participating in this plan to try and build a united front regarding this global tax minimum. Section 899 does also explicitly highlight diverted profit taxes as another unfair policy that could warrant this penalty, with this being a tax enacted by countries like Australia and the UK to, similar to the other two methods, try to prevent multinationals from diverting profits outside their jurisdiction for taxation purposes. And these tax programs have for a while been controversial in the United States and a point of discontent by the administration, both under Biden and Trump, given that they do disproportionately target US companies, given that the US is the home to many of these large multinational internet service companies. However, proponents for these taxes argue that they help to modernize tax programs to prevent the exploitation of varying tax programs around the world by large multinationals, and they look to compensate countries for revenue that's ultimately lost by, quote, the ability of highly digitalized companies to escape source-based taxation by avoiding the physical presence thresholds, with Canada itself introducing a digital service tax of 3% just last year. And while there are nuanced arguments to be had around these tax policies, this line of reasoning is actually the same being applied by the United States when charging withholding taxes. The idea that the government is looking to get a cut of income that's going to foreign investors. It's not just the United States that has withholding taxes. It's pretty broadly accepted internationally, which is why we have countries like Canada and many others offering a foreign tax credit on income generated from investments in the United States. However, the primary point of contention here, again, is that it's primarily US firms that are going to be paying these newly introduced taxes. So it seems pretty clear that this new section, especially given the escalating nature of the withholding tax, is being used as a negotiation tactic, whether that be to try and ultimately get countries to walk back the digital service tax or UTPRs, or to provide the administration another bargaining chip in ongoing trade negotiations. However, if implemented as is, the implications are pretty far-stretching. As mentioned, this impacts not just individual investors, but also governments, corporations, and trusts, among other entities, meaning again that even US positions held through an ETF or mutual fund will still see this higher tax on income. And it's pretty clear that a lot of people will be impacted. The US is by far the #1 destination for foreign capital, with US equities making up nearly 3/4 of the market cap of the MSCI World Index, a gauge of the global stock market, and JP Morgan estimating that foreign households have a typical allocation of 10 to 20% to US assets, with it definitely being the norm to hold US positions even if you're based outside the country. It could also impact foreign company profits if they have operations in the United States based on how they're ultimately structured. And even individuals who themselves don't hold any investments could still see an impact. In Canada, for example, the Canadian Pension Plan, or CPP, is a retirement income program currently exempt from any US withholding taxes that most employees in the country pay into to receive payments in retirement. However, with the change explicitly stripping away the Section 892A withholding tax exemption for discriminatory foreign countries, it appears that the CPP could soon see withholding taxes on its US-based income returns. And with almost half the plan amounting to hundreds of billions of dollars being invested in US assets, a higher withholding tax could impact the retirement payments that Canadians are ultimately able to receive. A similar situation faced by Norway's Sovereign Wealth Fund, the largest such fund in the world, who has over half of its money invested in the United States. So with these plans being used to fund social programs, a higher withholding tax is going to have a meaningful impact that, again, stretches beyond just individual investors. So yeah, pretty negative impact for any country or investor that has exposure to US investments that generate income. But what does all this mean for the United States itself? Well, the Joint Committee on Taxation has estimated that Section 899 could generate $116 billion in taxes for the US government over the next decade. However, that seemingly assumes no meaningful change in how countries and foreign investors invest their money. And as you would expect, an additional 20% fee on investment income is going to discourage US activity. An investor who's earning a 6% income return from a US investment who's hit with this fee would see their net return drop to 4.8%, and perhaps even further if previous withholding tax exemptions are circumvented, which would make that US investment less competitive to other options, which matters given that roughly 20% of total investment in US securities comes from foreign investors. This is also particularly notable when it comes to US Treasury bonds. While again, the House Budget Committee report does suggest that these bonds would not see an impact from this new tax, experts are still concerned that the wording of the legislation could possibly allow for this, something that would hurt the US government's ability to raise capital, likely increasing Treasury yields further, and possibly even impacting the US dollar, which would see less foreign demand if these taxes ended up broadly targeting other countries. And with the US running a current account deficit of over $1 trillion annually as of 2024, meaning it relies on foreign funds to make up its own gap in savings, that could impact the country's ability to meet its spending and investing objectives. And again, outside this fee just directly making US income generating and investments less attractive for foreign investors, it again is just one more thing that erodes a bit more trust in the US market from other countries. So while this action still needs to be approved by the Senate, and while the US government may choose to not ultimately implement these changes, if left in place, it could prove painful for foreign investors who hold US income generating investments, and it could impact investment in the US economy and the US stock market, which might see a decrease in the valuation premium that it's long demanded. As for what Canadians and other foreign investors should do with this news, I do believe it's an important story worth keeping your eye on. It does seemingly warrant waiting at this time for further details, given how much really is up in the air with all this. Again, the bill hasn't even passed through the Senate yet, which, yes, is Republican majority, but is less prone to pressure from Trump here, given that they don't face things like the 2026 midterm elections. We could also see the US government not choose to implement this if it's, say, entered negotiations with other countries, although I don't know that we would see these other nations walking back, say, the digital service tax, nor would we likely see countries like Canada increasing their foreign tax credit to try and nullify the impact on individual investors, given the punitive nature of this additional fee. And again, the earliest we would see this additional tax is in 2026, at which point it would start at that 5% level. However, if this tax does go into effect, it could very well justify changing how you invest in the US market, whether that be shifting to more capital gains focused investments or companies that carry out share buybacks versus paying out their income as a dividend. To that point, we could also see US companies changing their dividend policy in the face of this to continue attracting foreign investors by shifting away from paying out a dividend towards other methods, retaining their income, or again, buying back shares. So sadly, I don't have my crystal ball with all this. This is very much a geopolitical situation that impacts investing. So very hard to predict how things will ultimately shake out. But something I wanted to highlight nonetheless to raise awareness for my fellow Canadians and other investors who might be based outside the US but hold US investments, whether that be in real estate or the stock market, to keep an eye on this. And I'll look to keep people posted if we have any major developments. Anyway, that's about it. Thanks for watching. If you found this video helpful, do make sure to like, subscribe, all that good stuff. It does help the channel tremendously. Let me know your thoughts on these policy changes, whether you agree or disagree with them. And as always, be safe out there.